we're talking about putting sovereign wealth to work. We live in what increasingly feels like a golden age of sovereign capital. The sovereign wealth fund, as a class of allocator, has actually been around for 71 years, since the Kuwait Investment Authority was founded in 1953. But sovereigns, particularly in this part of the world, have become vastly more powerful and more sophisticated in the past decade. Mohammed, please start us off. How has the QIA evolved, and what observations would you make about the evolution of your peers?
A great question. So it's absolutely true. I mean, the sovereign wealth fund, if you combine them, it's about probably $11–12 trillion. This equates probably 11–12% of the global global equity market capitalizations. And looking at the region, it's probably around $4 trillion, so it's quite large and sizable.
And growing.
Demonstrated a great way of discipline as well to governments. Operating with an opportunity cost, which is saving and preserving capital and growing capital, is a great way to demonstrate how well are you actually performing. So it was a way for governments to preserve capital, to grow capital, to think about finding a way to diversify away from hydrocarbons. They developed, generally speaking, in this region, great level of sophistication. We in QIA, we've been established probably early 2000s, very early on, when Qatar started to have excess cash reserves. It was a great decision to demonstrate discipline and start to think very early on how do you shape your future and preserve your capital and grow it. Very proud of QIA. We're now super sophisticated investor, great reputation globally. We've been expanding into new asset classes and new strategies as we go. We're long-term oriented as well as a partner. So the evolution has been gradually moving more toward greater depth in terms of knowledge, greater investments in human capital, and pushing ourselves more and more to become more and more sophisticated in the asset classes that we believe that they're there to stay, and making sure that with time we alter our style to adapt to the long-term bets that we have in mind.
Katie, you spent 20 years in asset management at Goldman Sachs. Now you're running TCW, which itself has been managing money for sovereigns, if I'm not mistaken, for some 4 decades. Mm-hmm. What observations would you share with this audience?
Great. So, and I think Mohammed hit on a lot of the highlights, but I'll elaborate on some of those. So just for people's background, TCW is a global asset manager. We manage around $200 billion of assets across largely private and public credit markets, but we also have a thematic equity business. And we have had the privilege of managing sovereign assets in the region for over 4 decades. And so that gives us some perspective in terms of how the institutions have evolved. And as mentioned, Mohammed hit on the highlights. I'll give it from an asset owner perspective. I think the biggest difference is that we've gone from, and the sovereigns themselves have gone from asking for product to really wanting strategic partnerships and solutions, is a good way to give the headline on that. And that includes a couple of things. The first is knowledge transfer and capacity building. For people in the audience, that's been very successful for us. So not only, we invest a lot in training, and hopefully that's beneficial to the secondees and the people being trained by TCW. It turns out to be very valuable for the asset owner over time, because those people we trained 20 years ago are now running big institutions. So I recommend everybody put the time into that. The second point I would make is that there's more desire to do customized and bespoke mandates, and we can evolve that a little bit more in terms of what that means. And then finally, and Mohammed, you should jump in here, but I think advocating appropriately aggressively on the economic contract between these institutions, I think the sovereigns have done a great job of that. They are obviously building wealth for future generations, and they are very sophisticated in partnering with us around shared economics, particularly where we are asking for anchor capital. And I think that creates a great alignment of interest with us and the sovereigns, and that's something that we've seen happen a lot more just in the last decade.
Cyrus, M. Klein and Company isn't just one of the world's premier advisors to sovereign wealth funds. Anyone who knows the business knows how instrumental your firm has been in helping the Saudi Public Investment Fund to grow and to diversify. Share with us your observations.
Look, I think the important thing with sovereign wealth funds that you have seen the evolution over time is that, they have really invested in peoples and processes, and that has been over the last 10 to 15 years. If you look at the evolution from being co-investors, they're doing now direct investing themselves. They're built teams, they're built processes, and that has really helped them garner into the top echelons of money management and asset management globally. And they're partnering with everyone from the Blackstones, the BlackRocks of the world, and partnerships with TCW. They are important partners. And if you just look at, as an asset class, Mohammed said 10 trillion just in the sovereign wealth funds. But if you look at central banks and other sovereign pension funds, that's about 50 trillion. So in a global economy of $100 trillion, half of that is dominated by, sovereign capital. And if you just look at in 2023 alone, $82.3 billion was invested just by Middle East sovereign wealth funds. That tells you the importance of this particular asset class of, two companies and two institutions.
I'd like to zero in on what makes sovereign wealth funds unique in a way. Katie, I suppose back to you. What kinds of opportunities do you think sovereign wealth funds can pursue because of their nature and structure that other large pools of capital cannot?
One unique trait is obviously the longevity of the investment horizon, which is a massive advantage for these pools of capital relative to other people who might have more near-term liabilities. So that stands out as the major differentiator for these asset owners versus other asset owners that we work with. Mohammed, you should opine in terms of how QIA thinks about it, but from our perspective, the sovereigns that we're partnering with that have that very long duration of capital are able to be very active, obviously, in private markets and to take that lockup both in credit as well as in equity. And given that private markets are growing quite exponentially and public markets have been stagnant, which we can come back to, it's a really important part of the universe to be involved in, and they are best positioned to do it, both with the manager and obviously through co-invest, and as you pointed out now, directly.
You're recently arrived at TCW, and so is your head of sovereign capital. Do you have plans to develop any product specifically, expressly for sovereign investors?
Absolutely. So clearly it does require dedicated coverage. It's a different base, so thank you. I have my two colleagues here in the front row who co-head our sovereign team for us, and we are going to do it, and we have done it. What I would say for people in the room is that because these investors are incredibly sophisticated at the sovereign funds, we're no longer coming to them and saying, hey, here's a great product for you. It's actually more about co-developing something together that makes sense for them as an asset owner and taps into our expertise as an asset manager. And I think that's very healthy, creates great alignment of interests. And certainly as an asset manager, when we're a liquidity provider, we expect a premium for that. And so it makes sense that sovereigns who have these large pools of assets that asset owners want, they need to be able to be in a partnership as a liquidity provider to these asset owners, whether it's anchoring or scaling an existing business or going into a niche part of the business that we're developing. These are all reasons that there should be shared alignment of interest and economics. And then just last comment to make in terms of how things have changed, there's also a conversation, that a really appropriate one, around us also investing our own capital in all of these countries too. And I think that's really important. And if I was sitting in the seat of a sovereign wealth fund and investing for future generations, I would also say, this isn't just about us investing outside this country, it's about you using that pool of capital to invest in the country. And so we're trying to be very thoughtful around that as well.
Are you specifically referring to, in this case, TCW's balance sheet?
Would be for our client, on behalf of our clients, okay. But one of our partners has a very large balance sheet where they're also very focused on this part of the world and making investments too. So I think that that's a very reasonable thing to be asking your asset manager to focus on.
Question on the duration, that's a great point. I mean, do not underestimate the power of ability to large, longer duration investments. Very powerful, and it's appreciated during volatile environments like what we had during COVID. People who afforded to stay longer were able to capitalize and leverage the opportunity, and entities, generally speaking, who wanted to seek liquidity, got really punitive on them. And duration also enabled you to put more equity and have lower leverage. The problem with duration is when you come with it's more difficult to come with allocation policies, because any small pivotal allocation policy that you make could magnify and could compound and have major impact. So and specialization is very important, like the way QI operates, and assessing where to spend time as when we design the organization is super important, because this would have incremental exponential impact on the long term over any portfolio that we manage.
What kinds of investments is the QA specifically looking for today?
I mean, we do. It's a bit of a quite difficult question.
No, I realize that's perhaps overly broad, but
quite broad. But I think two things. I think if we could marry investments that are generally long-term in nature, they could compound with time. Marry it with some of the themes that we have, that we believe in, digitalization, decarbonization, sustainability as well, inclusivity, growth. So some of the long-term themes, this would be a great combination to have. We do invest as minority investments most of the time, so having like-minded shareholders and stakeholders is super important.
Are you interested in control investments, and do you see yourselves doing more of that?
Control investments require operational capabilities, require turnaround. With the quantum of capital that we're putting out of the door every year, this would be quite a difficult job for us. So we could selectively think about control, but the majority investments are not control investments.
Katie made reference to this point just a moment ago. Does it feel to you right now, Mohammed, like you have more negotiating leverage in asset classes like private equity as other sources of capital, such as U.S. pension funds, dry up?
Grow
more reluctant?
There is still ample of capital available, but it's much less than what it was 18 months ago. So we definitely have more negotiating power, but not only as a buyer, as an investor. We have negotiating power because we demonstrated to have a steady hand along the cycle. But there's less money, and there's markets have been quite challenged. There is much less number of IPOs and public listing. There is less number of M&A. The financing environment is quite difficult these days. So yes, we do. But it's because of the availability of capital, and at the same point of time, the style of being a steady hand long-term investor throughout the cycle.
Could you generalize, perhaps, what were things like from a negotiating standpoint pre-pandemic or even a decade ago, and what are they like today?
Just before the pandemic or right after the pandemic, 2021 or so, there's private equity, there's growth, probably in private markets and settings. You would easily submit a term sheet, 2 weeks on it. Another term sheet will come from another investor, which is 25% up. You'll have 2 weeks to come back. We felt that it was quite a frothy environment. We actually under-allocated, we under-invested in both 21 and 20. But it was quite a competitive. List diligence was available. Easier financing terms were offered. The environment is quite different now. It's not easy to get a loan.
I want to just add the point, and if I could emphasize something Mohammed said, because his team's obviously leaders at this. It's not just the quantum of capital, which is obviously attractive, but also, Cyrus, you mentioned this too. It is the capacity building that's happened in the institutions, that the sophistication is higher, and that they can and that you're able to participate directly in these investments. So it is about the sophistication level, the ability to show up and act with alacrity as a co-investor, and also to do it on your own, and for us to partner in investments. And that has obviously gone up dramatically in the last decade plus. And so it's those two things, I think.
But I think the thing I'd add is, if you think about the theme of energy transition that everybody talks about, there's a lot of capital that is going to be required if you want to achieve net zero goals, whether it's 2050 or 2060. So, depending on who you want to quote, the math is around $200 to $300 trillion over the next 20 to 30 years. And for that, you need long-term patient capital. And I think that's where sovereign wealth funds and investors are going to be critical. And we saw that in 23. If you look at sovereign wealth funds invested about $24 billion in clean energy projects, which was above than the 18 billion that they invested in 2022. And they're investing in green hydrogen, they're investing in renewables, and they're investing in things that today may be low rate of return, but over time can generate significant excess returns as we decarbonize our economies. And therefore, I think it is going to be a critical role that sovereign investors are going to play. And most recently, we've seen that in the mining sector, because if you don't have long-term patient capital, you won't have the metals that you need to decarbonize the global economy.
Yep.
Cyrus, I asked Mohammed about control investments. Earlier, I also mentioned the PIF. The PIF has a very broad investment mandate, both internationally and domestically, and it does do control, everything on the menu almost, from Lucid, the EV manufacturer, to Live Golf, to Neom, the futuristic greenfield city, to even Saudi soccer clubs. If it isn't the QIA, do you see other sovereign wealth funds following, if not that lead, doing more of that kind of investing?
I think it's a more question on the objective of the fund. Some funds have just an agenda of returns. Some funds have agenda that they have to build their domestic economy. It all depends on the fund's objectives, and each sovereign wealth fund in that regard is a bit different from one another. So I think it all depends on what the sovereign wealth fund needs to achieve in both their international and domestic agendas. And people are going to do controlled investments or significant minorities, so they have the right governance and control structures in place in order to make sure that that capital is appropriately utilized and the returns are appropriately generated.
At the very least, and this is not meant to make Katie feel bad, do you see more sovereigns or quasi-sovereigns building out their own capabilities, right, and doing investments directly, effectively bypassing professional managers?
Like we've seen funds do that, and they have built capabilities. But I think over time, what they have done is they built partnerships and built an ecosystem where people can take lead, and sovereign wealth funds can take lead. Where they used to be followers, now they can be leaders. I don't think that is going to any way dampen the effect of other big institutional investors. I think it's a good partnership that sovereign wealth funds have developed with institutional investors.
And there's some investments, like we've observed a more barbell approach where the very liquid investments obviously can be executed very much in-house, as an example. On the private side, we've already established the fact that some of that can be invested very well in-house with the capacity that's been built and the investment capability that's been built. If you have good governance and great investment capability, you can do a lot yourself, and that's fine. That's actually healthy for the ecosystem of sovereign investing. I think there are certain areas where, and Mohammed, you should jump in on this, but where partnerships still make sense, because someone might have a specific area of expertise that you want to leverage, and so you just have to have a model that can take advantage of the in-house expertise and then partner in parts of the market where you want to leverage expertise. So for us, as an example, I'll give one out that we've announced recently. We've been doing private credit investing at TCW for about a quarter century is our track record. So we've done it through 4 recessions. And one of our major partners the last 15 years has been PNC Bank, which is a number 4 middle market lender in the US. And last week we announced that we're going into a partnership with them, with both parties committing capital, both parties committing investment resources focused on the middle market. That's, I would argue, a really defined area and edge of expertise that we have on US middle market lending with a low loss ratio that sovereigns are going to partner with us on and provide anchor capital, because we have a unique edge in doing that. So I think it's going to evolve as partnerships.
I agree with you. I think Erik is absolutely right. It's impossible to be able to do all strategies or all geographies alone. There is talents also are not very centralized. Talents is spread. Human capital and talent globally. Some strategies you need to be really insider to markets and very well aware. Private credit is a great example of which. Typically those companies issuing or to be financed have been multiple times in the market. You have to develop some knowledge and some direct relationships. So there is a question of scale and accessibility, and also what are the key priorities in asset classes where you're going to be a major player versus strategies and priorities that you think better be efficiently done outside.
Tell us how QIA is balancing those forces. Where do you think it makes sense to invest internally and build out direct drive capability? And where over time, you mentioned private credit, but do you think it does not make sense to develop internally?
I will not reveal our secret sauce, per se.
That's what everybody's here for.
But scalable asset class. So we build very long-term investors in large, established public and private markets, private companies. And we believe some of the positions we have are generational. Other positions we believe are not generational, and they could be swapped and thought of recycling capital to other strategies. Other areas like real estate and infrastructure, we've been direct investors for a while. We have great teams across QIA, but in infrastructure and real estate, for example, those are long-term, semi-inflation, protecting, yield-focused. So there, it makes sense for you to do direct more than funds. We've been investing in technology quite aggressively over the past 5 years, but we've much more competitive in later versus earlier stage. So in earlier, we depend more on funds versus going direct. In later stages, probably direct makes more sense. And there is also a lot of synergies that we build in-house. So from earlier to later to being public, and so there's a lot of synergies that we could build from direct and indirect strategies in terms of communication and knowledge and co-investing beside partners.
I love that term, generational investment. What's a good example of one of the QIA's more generational investments?
I can't say, because if I say the management team of that investment will become lazy. So we say generationally inside. None of us is really confident. We actually push them quite hard, and we could recycle and be off and reduce positions quite actively, and we've been doing it.
Here's another question for you, Mohammed. Sovereign wealth funds are, by definition, sovereign actors. So I'd like to know, I suspect others here might like to know, does the current state of geopolitics force you to limit your investment options or choose more carefully?
Sovereign actors is quite a wide term, to be honest. I mean, you have an issue, because it's an issue. It could be positive, could occasionally be negative, because you're attached to a saving account of a state. But most sovereign wealth funds have, policy statements, great governance standards. They have transparency in terms of how they execute, great anti-corruption, anti-money laundering. QIA, for example, we have the highest standards. Our partners actually fit up when they deal with us. So we actually want to make sure that we do everything ultra by the book, because you have an international threat. If you do a transaction that is negative in Hong Kong, it could effectively affect your position in the U.S. In terms of constraints, I don't think it's been ever any type of constraint. I think a lot of, with the sophisticated kind of investor base, they know you well, and many times they know the teams, and so there's not much constraint really we faced.
Let me flip the question on its head then. Given how much capital is exiting China, for example, does that create better opportunities there for QA?
It does. It does.
And should I interpret that as being you're more willing to commit capital to China now than perhaps you were before?
So it's two things. So we view, from a commercial standpoint, general statements, equities in China generally are under pressure for a good reason, right? Which is a lot of the U.S. capital actually have left. In China, in Asia, for example, in China, we're quite selective in where to invest capital in. We make sure to invest in businesses that are consumer-driven versus, for example, critical industries, basically, which could have IP issues, things like that. So other than that, we're quite positive, and there's a lot of good things in the Chinese economy.
Cyrus, do you think countries like the United States, for example, which has a very formal review process for foreign acquisitions, will make it, over time, more difficult for sovereigns to buy companies there?
Well, that's a question for the U.S. government, I think. As a deal maker, I think U.S. reviews transactions, has been reviewing transactions for a while, but that's more geopolitics than anything else from my perspective. I think the one thing that I would add, that what you've seen in the, how sovereigns have also been instrumental in developing their own capital markets. If you just look at over the last 5 years, about $75 to $80 billion have been raised in IPOs in the GCC region alone. So they're developing their capital markets. Their capital markets are growing, and that has been a very positive effect of sovereign investors and long-term investment. I think that needs another session to have that conversation, but that's something that I just wanted to point out, that it's important to build the capital markets and the institutions.
I want to stay with you for a second, and this will, unfortunately, folks, be our last round of questioning. The point that you made earlier, Cyrus, about objectives. Most professional investors have a singular objective, right? Maximizing risk-adjusted returns. Many sovereign wealth funds are different, especially those, as you pointed out, with a mandate to promote domestic or regional economic development. How do you think about the way a sovereign wealth fund, should define discipline? And how would you measure that discipline if not strictly by returns?
Well, I think, if you look at a lot of the sovereign wealth funds, and most major sovereign wealth funds today publish their policies and procedures. And, if you actually read them carefully, even though they have a mandate to invest in certain industries that at a particular point in time may not be very profitable, but they have a long-term goal of maximizing returns. So I think, at a snapshot, if you measure returns, that's not the right way to measure returns for any sovereign. You have to look at a 10, 20-year horizon, because that's the duration of the capital, or even 30 years, as you asked Mohammed, in terms of what is the best generational investment. I think only time tells that, but I think they have the policies and procedures in place to combat that challenge.
Katie, how do you think about it?
I think that one of the most powerful aspects of these sovereign funds, we've mentioned it before, I'm going to end with this and then come back to what we're doing in the market now, is the ability to be a capital provider, particularly when liquidity dries up. So they have negotiation power. As Mohammed mentioned, I'm sure all the asset managers in the room were super excited to hear about your strength and negotiation power, but I'd agree they all have it, of providing the capital to us. Then from our perspective, because we haven't touched on market outlook, but I'll just end with what we're seeing in the world. The most significant thing we're seeing in the world is an inconsistency between where some of the risk assets are currently priced and what we perceive to be some of the risks out there. And so I want to end with liquidity provision, which is one of the best ways to make money. If you look at the market now, I'll just take credit because I have 27 seconds. So credit spreads are at their tightest levels they've been in 20 years. And I think we can all give a very long list of reasons why there's actually reasons that we are late cycle and reasons to be worried about the macro. I think it's a good time to be more conservatively positioned. For us, we're overweight agency MBS that carries over the fixed income markets, and wait for something to break, which it will. And then those sovereign assets that have been entrusted to us and negotiated very effectively on the economics will lean in and be a liquidity provider when that happens to those companies and get that premium return for our clients in private and public markets.
Mohammed, last word to you on how to define and, importantly, enforce discipline.
A few things. I'm not sure if most, but majority of sovereign wealth funds have clear investment policy statements, as indicated. They discipline in terms of asset allocation policy that they have. This is how the discipline is probably pushed out. They have a lot of good governance, generally in boards, etc. And they revise their position as well. So at some point of time, if developing the local economy is important, so then they could include, theoretically speaking and practically speaking, matters like the economical multiplier effect on the local economy by the decision they encounter and execute. Don't forget a lot of sovereign wealth funds.
That is, of course, the hope.
Yes. Don't forget, a lot of sovereign wealth funds also have a lot of businesses in-house, actually. So they could use their investments, existing portfolio companies that operate internally, to be fostering economical growth versus them directly doing those kind of new investments. So discipline could be definitely enforced through clear investment policy, good governance, and periodic revisions.